Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast. We wanted to do one more interview here before the end of the year. Our guest here today was very persistent. He wanted to get his predictions for 2012 on the record. So joining me here today is portfolio manager of the Vishni Fund and contributor to the Morgan Report and a good friend of mine, Chris Marchese. Chris, thank you for joining us here today.
It's great to be back. Thanks.
Now, Chris, I wanted to just jump right in here about some of the pertinent things that are going on in the markets that are really driving the markets. And I think you'll agree with me on this. The markets are unbelievably short-sighted at this point in time. And I think a lot of that has to do with what's going on in the ECB and, with these large banks here in the EU and how we're starting to see, bank runs on the periphery and some of these other things. Can you talk about that a little bit, and if you think the Federal Reserve might be able to intervene on the behalf of the ECB, if you think that's likely to continue to happen, or if it's already happened, and if you think we're going to see it on a larger scale?
Sure. I think, the markets are short-sighted, but they also, there's a lot of uncertainty out there, so that's why you're seeing all this volatility. The ECB keeps saying, they've come to an agreement to bail out the banks, so then that doesn't happen. So, if nothing gets resolved, the Federal Reserve is going to have to step in and start buying European sovereign debt.
Yeah, and I think that's a good point that you mentioned here. We're seeing the Federal Reserve be willing to basically do whatever it takes to maintain the status quo. And the status quo, I guess, is to preserve a lot of the political and economic powers in the G7 here. Would that be a good summary of what is going on?
Yeah, that's spot on. And, they're a big trade partner, so we don't want the euro to go, to par with the dollar, because that will hurt our exports. So, plus we have the whole banking system's interconnected, so it's a systemic problem.
Yeah, and if the our exports get hurt, Chris, then they can't make it look like we had phony GDP growth.
yeah, it's unbelievable.
Okay, well, are you still seeing continued speculation here from these large European banks on levering up and buying European debt? Do you see in Europe worse than the MF Global situations here for some of these large European banks?
Yeah, the ones that aren't capitalized, like Dexia, it performed superbly on the stress test, and a month later, it needs a bailout.
Well, the question I would have then, Chris, is what were the guidelines for the stress test?
Yeah, that would be great if they made them public, but, we know that they're not going to give out a lot of detailed information.
And you mentioned, Chris, that there's this interconnectedness of the banking system of all the large cap banks, because they're all holding each other's, bad paper. They lend each other money. What is it, through the London interbank lending stuff, and they sweep the accounts of their customers to lend to other banks overnight, and then they're also buying, the sovereign debt of the U.S. and or the ECB countries. And have you seen a lessening of risk reduction here by the banks, or do you see that the bankers are still, taking privatized profits and the losses are being socialized, and the leverage ratio of these bank stocks, they're just, continually gambling with more leverage?
Well, the ECB just cut the reserve requirement from 2% to 1%, so they can leverage up another 2 to 1 times just based on that. And Chris, I think you wrote an article recently about how inflationary that is. Can you explain to our followers, our listeners, pretty briefly about why that would be inflationary? Well, basically, it's like when we bailed out our banks, they're borrowing from the ECB with the for a low rate, and they're basically restoring equity in these banks through capital injections. And they say it's a repurchase agreement, so these banks will have to repurchase these in the future. But I mean, they're not going to be able to be recapitalized without a complete washout of the system. All the imbalances need to be cleansed. So basically, what it is just an artificial, papering over of the system for a while.
And you would also say then that the capital that's being given to these banks is not being used productively. It's not being invested, in creating long-term private sector jobs that create value and grow a productive economy. A lot of that money, you would say, is probably still being used to speculate with or to allow these governments then to continue to borrow, at low interest rates on their debt because, I guess some of these large banks are still buying a lot of sovereign debt with that cash that they're getting.
Yeah, it's hard to tell. I mean, there's just looking at the 3-month LIBOR rates over the past few months, things are intensifying. So it's getting worse over there. And if this goes on, we'll see another 2008 in Europe, but I doubt that'll happen. The Fed and the ECB are more than prepared to print as much money as they'll need to, or as is required.
Okay, so you would think then that this dollar rally here is not going to be a permanent thing perhaps for all of 2012 then. You think then that this might only last, I don't know, maybe half the year or something like that at most before Ben announces, I don't know, a humongous stimulus program that's tied to the jobs bill that's targeting GDP and, they're going to keep creating more and more liquidity in the system and stimulating the capital markets.
Well, ironically, them not bailing out these countries should be good for the euro, but the euro is starting to go down. It should be going up. And the same will happen if they do come to a bailout agreement or the Fed rescues Italy and Spain and Greece. The euro will go back up even though it should be getting weaker.
Yeah, I agree. And I think the markets at this point, Chris, are acting kind of counterintuitively because, to transition to another point here, I think gold is definitely a safe haven. Gold is money. It's a safe haven. And, if things are falling apart like that and we're still not seeing, any long-term progress here in the United States to correct a lot of the imbalances and misallocations of capital and things that are fundamentally wrong with our economy, gold should not be getting smashed like it is. So can you talk about why you think, despite all these positive factors for why gold should be a safe haven, why you think the paper price for gold is going down currently?
I just think the overall consensus is the Fed may not come in and print a bunch more money, but we know, you and I know, and other gold and silver investors know that's not the case. They'll do whatever it takes. I'm guessing QE3 is going to be pre-announced in January, March at the latest. He needs to make things look good for Obama going into the election so he could get reappointed. So, then we had the smash from 1900 down to 1500, and, investors, they don't have a high conviction in the precious metals yet, except for the strong hands, which have been buying on these dips.
Yeah, Chris, and what I'm also hearing, too, is the continued and largening dislocation between the paper gold price and the real physical market. From other sources that I've heard, I've been hearing that large buyers of physical gold are going directly now to larger miners and or larger refiners, and some of them are willing to pay $1,900 an ounce to get larger orders of physical metal while the paper price continues to drop. So I think this is something that people need to account for in their portfolios, and they need to understand. And I think part of the reason that gold dropped so much, Chris, I don't know if you agree with me on this, is that there was a lot of leveraged money in the paper gold price in the futures market. There was a lot of hedge fund managers and other short-term hot money momentum players, and they just didn't, believe in gold long-term. They didn't want to buy physical and pay money to have it stored. So they levered up to a higher gold price. They're expecting QE3, too rapidly after QE2. They weren't expecting a disinflation period like we're getting now, where the Fed waited for things to cool off and waited for commodity prices to come back down. And then, also this is the end of the year here, so we have some tax loss selling. So do you think that's pretty accurate for describing some of the reasons why the paper gold price is down at these levels right now?
Yeah, I mean, it's really hard to know. I mean, some of it could be due to MF Global, window dressing, so a lot of funds taking profits at the end of the year to make their returns look good, tax loss selling. There's not a lot of speculators long right now. It could be a lot of different things.
Yeah, and yet a lot of the statistics I see, Chris, and I don't know if you've seen all the same ones I've seen, but a lot of the ones I've seen for physical bullion buying, the investor demand for physical gold and silver is still increasing rapidly, especially in the G20, the developing countries like China and India.
Yeah, it's still going, and China just announced either today or yesterday they're not going to allow their citizens to trade on private exchanges like the COMEX and whatnot. So things like the Pan American Exchange should grow pretty fast and hopefully delegitimize the COMEX to some degree.
Yeah, and they're hoping to get, I believe, the Pan-Asian Gold Exchange implemented, I think, by June of 2012 to get it fully up and running. And each of those contracts is going to be backed by like a 10-ounce gold bar, right?
Yeah, it's going to be fully backed. So it's because their contract sizes are as small as 10 ounces, so that's essentially 1-to-1. It won't be fractional bullion banking.
Well, I have some more questions on gold. I want to ask you, why do you think Wall Street sell-side analysts have a lower long-term price target for gold than the current spot price?
They just don't understand the metal. It's been prior to 2001, 2002, it was in a bear market for 18 years or so. And, a lot of people don't look at gold as money yet because they see that gold exchange standard failed in 1971, which wasn't the case because that wasn't even close to what a gold standard is. It's really hard to say why they have that. It's ignorance. They don't want to be wrong. But there are a few good ones out there that understand the story.
I have my own opinions on that, Chris. Now, I didn't work on Wall Street. I worked in financial services. But, after speaking to a lot of former people who did work on Wall Street, interviews and speaking to those people directly, from the information I gathered and from their opinions and the stories they've told me, is that Wall Street's view is that when gold is doing well, Chris, and people have higher gold price expectations, it is very tough to sell other paper assets, the stuff that Wall Street makes a lot of money on. So the types of stocks, mutual funds, bonds, those types of things. So when gold does well, all those other things normally are not going to do well, and that's going to hurt profits in business for Wall Street. So I think that's part of the problem here, is that these analysts, Chris, are not being allowed to be objective, as objective as they should be based on the facts, and there's some bias, or they've been ordered to, not be bullish on gold.
Well, yeah, they're given a gold price deck by the company, and then they can only model it based on that price. So, there's a lot of reasons. But if we get QE3 and, more printing in the Eurozone, gold could just it could be at 3,000 by the end of next year. I mean,
well, that's interesting. We'll get into your price targets for 2012 for gold and silver a little bit later in this interview. But I think you touched on something a little briefly here, and I want to expand on it right now. Is that a little bit lower in the short-term gold price and silver price, it's going to really benefit the companies that are already producing gold and silver, that have these record free cash flows, their profit margins are expanding, their dividends are also, starting to rise. I think some of these guys are going to come in, these larger producers, and they're going to say, holy cow, I can go and buy like the gold in the ground at some of these juniors. I can buy for under $100 an ounce on some of them. So do you expect a lot more M&A activity in the next 18 to 24 months if gold and silver, go a little bit lower, correct a little lower, or even stay in a trading range, the paper price stays in a trading range?
That's a tough one. I mean, I think it'll expand year over year, but the fact that a lot of these companies, there wasn't too much M&A when gold prices were high and the equity prices were depressed makes me think otherwise. I mean, I think it's more of the mid-sized company looking to, become a mid-tier or intermediate / senior producer that are the ones looking to do a lot of M&A instead of Barrick, Gold Corp. I think they're looking for things, and we'll see. I think it'll pick up towards the latter half of the year, but it's hard to say.
Yeah, because I mean, even at these price levels, even at $1,500 an ounce gold, a lot of these producers are making very big profits. What most people don't realize is that prior to 2008, the input costs for a lot of these miners, especially the energy input costs, were rising on a percentage basis so rapidly they were destroying profit margins. So after 2008, the real price of gold as measured against the Rogers Raw Materials Fund, the real price of gold bought, instead of 15% of the Rogers Raw Material Index before 2008, after 2008, it bought 44% of the Rogers Raw Material Index, and that's around where it is now. So gold's purchasing power is buying a lot more of other, commodities now, and that is really good going forward for the profit margins, I think, of the gold miners.
Yeah, a lot of people are saying that, gold's bubbles burst, silver's the bubbles burst, but I mean, compare it to all the other commodities. They've gone down a lot more. I mean, gold's still up, 14, 15% for the year. And the average appreciation over the past 11 years has been 17%. So it's not like it's been a terrible year.
Yeah, and exactly, Chris. And inflation or deflation, I expect gold to perform well because, even in a disinflation scenario like this, exactly like you mentioned, look at the other input costs for a gold miner, and they've dropped during this temporary period here. Whereas gold has not dropped quite as much. So I think the gold miners are in a nice sweet spot here. Obviously, that'll be confirmed by the earnings to see if they've controlled their input costs. And, they're still producing at the right guidance rates going forward. But I think the gold miners are in an absolute sweet spot here. And a lot of these, mining company CEOs, if you talk to them, they still expect higher gold prices. So I think some of them, like you said, the mid-tier producers are going to be more aggressive than perhaps like the conservative, the large-cap guys, and they're going to look to make acquisitions.
Yeah, as soon as, there's a lot of projects out there that these companies, the CapEx is higher, really high, and, they need to generate a certain amount of free cash flow, which for the most part hasn't been picking up that much yet, despite, earnings increasing, because, they're reinvesting it into future growth. So, as soon as a company like we saw Aurico pick up Capital Gold and recently Northgate, more things like that, as soon as the CapEx requirements die down a little bit, because you don't want to be stuck with financially overextended if we do, for some reason, gold comes down to 1,200, and some companies don't make a profit at that.
Yeah, exactly, Chris. And you don't want to get into a situation during a disinflation period like this where you've just taken on a lot of debt, or you need to go to the markets to raise debt or to, get more equity if you're a junior, and the price is dropping rapidly. And, you don't want to be in a Coeur d'Alene type situation where you're bringing on like a large gold and silver mine like Palmarejo, and the price drops really rapidly, and then all of a sudden you're having to sell 1 million ounces of gold in the ground at Palmarejo for $80 million to Franco-Nevada when it's worth $1 billion, right? So.
Oh yeah, I mean, I think Palmarejo is a great property, and it's, when all is said and done, they'll look back at that and just, say this is the dumbest thing we've ever done.
Well, unfortunately, Chris, in this macroeconomic environment, a lot of the CEOs are, they're not going to be as adaptable to doing, having cash and minimizing debt. And, they're going to we are all human, and, there's not as many great CEOs in the resource sector as there are in other sectors of the economy. For every Nolan Watson or Keith Neumeyer, there's dozens of guys that are, at best average. So this is a situation here where obviously Coeur d'Alene screwed up the financing there for 2008. They, had a liquidity problem, and they did what they had to do to survive, but it obviously destroyed long-term shareholder value.
Yeah, I mean, but Coeur d'Alene didn't need to be in that position. They weren't prepared. They didn't look at every outcome.
Well, yeah, I agree. But my whole point of this, Chris, was that a lot of CEOs at a good number of mining companies are making a lot of the same mistakes. Now, maybe we haven't seen them yet materialize, or they haven't been on the scale yet. But, you look at some of the deals that Nolan Watson has pulled off, and I was just hearing that, Luna Gold had only 1 million ounces of gold in the ground when he went in there and did that gold stream a couple years ago, and now it has over 3.8 million ounces of gold reserves.
Yeah, they increased it 250%, and that's just the beginning.
Yeah, so this is a time, Chris, where, people need to be more discriminatory with their capital, and, they need to make sure that the company where they're putting cash in, the majority of their capital into, is, producing, they're generating cash flow, and the company's being run so it has like a good cash position there so it can weather out the storm.
Yeah, exactly. I'm not too worried about them at this point, except for the ones that just have out-of-control costs. But, you never know.
Okay, well, Chris, I want to move on to some of your predictions here for 2012, because that was one of the main reasons why you were so adamant to get an interview in here with me before the end of the year. So if I'll leave the forum open to you now, and you could talk about some of the things you see happening in 2012 in the commodities markets, or with governments, or with the central banks, or with anything geopolitically in general.
Well, that's a broad question, but I'll try my best. It's, if we think we've seen volatility this year, I think next year it's just going to be outrageous. In the equity markets, bond markets, the precious metals, just about everything. I do expect a lot of money printing next year, and bailouts of more banks, kind of like a mini 2008, but not as bad. As far as gold and silver goes, my prediction for this year was $50 silver and $1,900 gold, and I obviously missed that one. But for next year, I think $2,200 to $2,400 gold is reasonable, and anywhere between $55 to $70 silver, depending on the size of QE, if Burack goes through with his $1.5 billion filing, and depending on how much he buys, Obama wants a $1.2 trillion debt increase by Friday. That should be good for the metals, if it goes through, because they're going to have to print more. Hopefully the CFTC resolves the position limits. They need to find out what a swap is, which I don't.
That's ridiculous.
I don't understand. I mean, in the Morgan report, David and I just wrote what the definition is. It took 2 sentences.
And Ted Butler wrote an article on that too, and it took like less than a paragraph to do that too. So I think that's a ridiculous excuse by the CFTC. Yeah,
I mean, I got to give credit to Bart Chilton. I think he's trying, but even he admits that they're not doing a very good job.
I think the best thing Bart Chilton can do, Chris, is go and start a hedge fund and go and take advantage of this opportunity and use free market forces to correct the problem.
Yeah, that would be nice. But, he's there to serve. He's one of the few people I actually respect in government. And, I think he's a straight shooter. But, at this point, J.P. Morgan's reduced a lot of their short positions, so it'll do a lot, but it won't be like before.
Now, in the scenario, I've been reading some articles recently talking about how these bullion banks, which have, been net short for a very long time, and, it's been a managed retreat, but the articles I've read have talked about how these bullion banks will eventually go net long. Do you see a scenario like that developing in the next 18 to 24 months where a J.P. Morgan has closed out almost all of its short position and gone net long and will drive up the silver price to triple digits?
I don't think they'll ever go net long. I just think they want out of that trade. They've already got a lot of heat. And I think they manipulate a lot of other markets, even though, I have no evidence of this. So there's really no reason to do it in the silver market because I think they've been identified. And, with the position limits, they can't go that long anyway. So I don't even know if it's worth it to them. I know a lot of looking at the COT reports, the smaller commercial banks are net long. So, that's encouraging. It's just basically the 4 and 8 largest traders that still have large net short positions.
Okay, and Chris, I wanted to talk a little bit more about some of these other G7 countries here and where they fit into the macroeconomic puzzle. Noted hedge fund manager Kyle Bass of Heyman Capital has talked in recent speeches about how he thinks the dollar has at 3 to 5 years before, there's a rout on the Treasury and the dollar and there's free market forces and bond vigilantes allowed. And the way he structured his bets is he thinks France and Japan and Switzerland could be the most next likely, larger, more well-known established countries to go. And he thinks in particular Japan is in the worst trouble because, they don't borrow from any foreign creditors. Their savings rates are dropping a lot because a lot of the Japanese people have spent almost all of their savings buying JGBs with no return on investment, basically for 2 decades. And then Japan has a tremendous xenophobia and a demographics problem.
Yeah, that's exactly right. It's really hard to tell who's going to go first. The UK is also a problem. Argentina's still having an inflation problem. We'll see what they do. It's really hard to tell, and I think, once one starts to go, it's going to bring down all the other ones. So, I don't see the dollars, outliving any of the other major currencies. I think it's going to come down pretty fast if that happens, along with the yen or euro or sterling or what have you.
Now, in that scenario, if we were to see the paper price of gold on the COMEX drop, I don't know, to 1,300 or something, around those levels, and then you were to see large offtake agreements negotiated with, these large refiners or large miners where the gold is not being sold at the paper spot price, where the gold is being sold for, I don't know, 1,800 or 1,900 an ounce. Do you think that that's going to make the COMEX, less relevant? Do you think that people are going to stop paying attention to the COMEX paper price then, if a lot of, billionaires and agents for governments are more and more demanding to go directly to the source because they don't want their money stolen in an MF Global scenario on a commodities market where, there's no guarantee that their money is going to be protected, or the rules are going to be changed about the futures contract, and instead they're going to go directly to the source there and pay a higher price?
I don't think that, the paper prices will get too disconnected from the physical and the paper, just because, you could do something like, buy a bunch of SLV and arbitrage it against the COMEX and what have you, or that and, NYSE Life or TOCOM or Pan American Exchange. So, I don't see it happening for that much longer. But yeah, I think that COMEX is going to be a lot less relevant just because you got other exchanges coming into the market. They don't trust us. And you got PSL, you got Sprott, the PSLV, his Gold Trust, GLD, the SLV, the SIVR, and there's a lot of arbitrageurs out there. So if it gets if there's a big enough discrepancy, they'll take advantage of that.
Yeah, I think that's definitely going to happen too, Chris. And like you pointed out earlier in the interview, I think the Pan-Asian Gold Exchange is going to really help once it's more fully implemented around June of 2012. I have one more question here before we start wrapping up this interview, and this is to help our listeners out there who are a little bit older than you and me, because, you and me are under 30 years of age, Chris. So we're looking for the opportunity in this crisis, we're looking to generate a lot of wealth for ourselves in this crisis. And our older listeners are looking to get some yield. They might have a job, they might be planning for retirement, and how do our listeners look for safe yields in this environment when what's happening in the bond market, all the interventionism and all the games, the real interest rates are negative? What types of asset classes or sectors of the economy should our listeners be looking for if they need yield?
If they need yield, you can go to something like an oil energy trust. The underlying stock price might drop, but if it has a 9% yield, that will just go up to 16%. So there'll be constant inflow, and I don't see oil going back, below 50 anytime soon, especially with what's going on with Iran and all that. Gold is, it's a good safe haven. There's no yield, obviously. I wouldn't go into long-term. I wouldn't go into any government bonds unless you think some country's going to cut. You might go in for a short trade, or just put it maybe in a foreign money market account for 6 months at a time and get small and income streams going. Then there's other equities. Yeah, that's a tough one. It's hard to get, a lot of yield anywhere. That's isn't loaded with risk.
Yeah, I completely agree, Chris. And I think you brought up a very valid point here with the Canadian Energy Trust. And the way these business models are set up for our listeners who are not familiar is that the company, buys like an oil pipeline in the U.S. or Canada, and they return a lot of the profits from operating the pipeline right back to shareholders. And then if they want to, go buy another pipeline, then they sell more shares to buy more assets, cash-producing assets. And the businesses are not set up, I don't think, as C corporations. I think they're structured as trusts. So I think, it's a lower tax thing to pay back to shareholders in the form of dividends. And these are something, for our listeners out there, and we do get a lot of questions from people who are older listeners here, and we try to cater to different demographics who need yield. So we're not just telling people to, be aggressive on the offensive side of their portfolio and load up on mining stocks because, right now, Chris, the mining stocks, a lot of them don't pay very big dividends, although we expect those to obviously grow in the next 5 to 7 years. You wrote a great article on this, I think about 2 months ago for Financial Sense. You talked about how the mining shares will eventually be the utilities of the future.
Yeah, and, a lot of them are starting to pay dividends or increase at an accelerating rate. The royalty companies, Newmont has tied it to the price of gold. So, they're at the early stages, but, for example, Silver Wheaton, that's, one of my favorite silver stocks. They just announced the revised dividend policy. It's 20% of the operating cash flow from the previous quarter. So even assuming the long-term price of silver is 25 or 30, their payout ratio is going to go from 20% to 85 to 90% in the future. So that's going to be like a 13, 14% yield.
Yeah, Chris, and the gold and silver miners are the only sector of the economy where pretty much across the board I've looked at where profit margins are expanding rapidly and where I think they're also the only sector where people can expect going forward capital gains in terms of share price appreciation and also large dividend increases. Would you agree with that?
Yeah, I mean, most of my investments are in that area. I work for a fund that's completely focused on it, so I obviously believe strongly in it. Yeah, I mean, we've seen a lot of dividend hikes, and the yields are actually starting to come up because they've just been taken out back. They're trading, at 2008 levels now relative to their profit margins and the price of the underlying commodities.
Yeah, and Chris, obviously the miners are in a lot better shape across the board than they were in 2008.
Oh, definitely. Cash balances, and there's a lot more avenues of equity financing, like Sprott lending. If you see something that's good and they need help, help them out in exchange for interest and warrants or something like that. And you got all these gold and silver royalty and streaming companies. So if you're a company with good assets, there'll be a way out even if you run into trouble.
Yeah, I agree, Chris. I think a lot of these junior mining stocks, I think a lot of the pain has already occurred in them, the ones that are not too close to production, that are more than 18 months away from production. I think a lot of the pain has already happened. The tax loss selling has already occurred. And, I think the mid-tier producers, like you said, like an Endeavor Silver or a Great Panther Silver or First Majestic Silver in the silver space, not talking about the gold ones, but I think those guys are all on the prowl for acquisitions.
Yeah, I was down in Guanajuato to see Great Panther and Endeavor in November, and I was talking to management, Brad, the CEO at Endeavor, and he's saying they're looking at everything. It just no one's willing to budge. They see the price going higher, and they think they get a better return for their stockholders, which I agree with. So I mean, they're trying. It's just no one wants to do a deal unless they get a huge premium, and they can't disappoint their shareholders.
Yeah, this will be interesting to see how this thing fully plays out, Chris. And maybe instead of the premium, like you said, for an actual acquisition, maybe we'll see some merging of assets together with companies here, so companies can go back to the market for debt and equity, better debt and equity financing to say, hey, we have a diversified asset base, we have multiple projects in multiple countries. Maybe we'll see more of that going forward.
I mean, we have, like, again, I'll come back to Arico. They only had 2 operations going at the beginning of the year. A good pipeline of assets, but acquired Capital Gold, which had seen gold mine, low cash costs, and assets added to their pipeline. Then they Northgate, they just acquired them, and they're going to have Young-Davidson, a huge premier gold mine in Canada, come online in 2012. So they went from operating just in Mexico to Australia, Canada, and Mexico, just in the past 11 months.
That's impressive, and their CEO is definitely going for it here. And I saw some of those numbers that you were throwing around, off topic here before we recorded our interview a while ago, and you said that they bought the gold in the ground for around $150 an ounce.
Yeah, that's about right. It's and the market hated it. They went, like, Arico went from 14, now it's down at 750.
Well, short-term pain, long-term gain.
And yeah, it just doesn't make any sense.
Well, the numbers, that the production numbers and the earnings numbers that are hit, because of the acquisition, will prove the market wrong then ultimately.
Yeah, I just feel bad for those who can't handle waiting. A lot of investors, have ADD and they need instant gratification, and unfortunately, you got to be. You just got to work through this, and if you believe in it, then it's not a problem. But I don't think that many people do, so they're panic selling.
Yeah, I completely agree, Chris. And to be honest, with my own account, like I don't even check the value of my account anymore, even once a month. So the only time I'm checking my account is, if I've already looked up the news stories for the companies. If I see something fundamentally has changed negatively at my company, one of my companies, and I don't like it, then I'm selling a position. But otherwise, then I don't check the value of my account 10 times a day. What I do instead is I focus on the news stories of my companies, making sure that management is executing the plan. And the only time I want to check my account value then is if I have more cash to invest and add to positions.
Yeah, that's another thing that just want to jump in real quick. If you're running out of cash at this point, you've done something wrong. You should never be out of, cash, because you never know what kind of opportunity is going to come along. So, for example, in the next run-up in equities, take some profits. Everyone should be taking some profits. Maybe keeping, at least 10% cash for an opportunity like this. I mean, I'm running low, but I'm still using part of my paychecks to just keep on buying. And I know a lot of people are out, which is frustrating when you see these prices relative to start of the year.
Yeah, Chris, and as long as you're not using leverage, as long as you're not buying your mind shares on margin, as long as you're not using the futures market, which has become a lot more dangerous now after the MF Global, the counterparty risk, and the other things that are happening there. So as long as people are using cash to buy their mining shares and they have a cash position, I think you're dead on with your asset allocation strategy.
Yeah, it's just, everyone makes mistakes, but these are really volatile times, which we haven't had in the past. So you just got to adapt to it as fast and as efficiently as possible.
Exactly, and as you know, as long as paper fiat currencies become more and more unstable, I expect this, like you said earlier in the interview, I expect volatility to worsen, and I expect this to affect all capital markets, not just the commodities markets. So, wrapping up here, Chris, can you tell our listeners about your new website that you have, and then where to find your work?
Yeah, I'm building the website. It probably won't be really going for a few months. I'm doing a lot of projects, so don't have that much time to work on it. It's AUAG, the symbols for gold and silver analysts.com. And it's basically just, some pics of mine, pictures from various mining trips, Mexico and Canada. I'll be going to First Majestic for 4 or 5 days in January. So should be some good pictures from the new Del Toro mine there. Other than that, I don't really write that much for other sites anymore except Financial Sense, the Gold Report occasionally, and, of course, the Morgan Report every month.
And, Chris, can you tell our listeners who might be interested in investing money in the Vishni Fund, can you tell them how to do so or how to contact you to get more information about, like, a prospectus for the fund?
Definitely. If you want just basic information, and we have a free newsletter you can sign up for, it's www.vishni.capital.com. Or you can just send me an email at chris.marchese, MARCHESE, at vishnicapital.com, and I will send you as much information as you need.
And I just want to thank you, Chris, for coming on here and spending the time to talk about your views and continuing to educate our listeners here on the Wall Street from Main Street podcast. You've already given them, a lot of great, valuable information in the many interviews we've already done here, and we look forward to having you back on here in the near future.
All right, great. Thanks.